By the time markets open Monday, silver could make a sharp move in either direction. And right now, most people are not positioned for it. Silver is sitting near $75 per ounce. On the surface, that looks stable, it looks controlled, but underneath that price, the situation changed over the weekend in a way the market hasn't fully processed yet. And that's where the risk and the opportunity is. This is not a clean bullish setup. It's not a clean bearish setup. It's something far more dangerous, a setup driven by incomplete information. On Friday, markets moved on hope. Over the weekend, that hope didn't turn into a resolution. And now Monday becomes a moment where everything gets repriced at once. Here's what happened. Iran sent a new proposal to the United States through intermediaries. On the surface, that sounds like progress. That's exactly how the market interpreted it on Friday. Oil pulled back from recent highs, and silver bounced roughly 3% off its lows. But here's the problem. The proposal doesn't solve the core issue, it avoids it. Iran is essentially saying, let's reopen the Strait of Hormuz, ease the military pressure, and deal with the nuclear issue later. That might sound reasonable, but from the U.S. perspective, that's a major problem. The nuclear issue is the leverage. If the U.S. agrees to ease pressure without resolving that, it gives up its strongest bargaining position. And that's why, even though officials said the proposal looked better than previous ones, the tone coming out of Washington was still skeptical. So now the market is stuck between two conflicting realities. On one side, there's a proposal that could reduce immediate tensions. On the other side, there is no agreement and no clear sign that one is coming quickly. That creates the exact type of uncertainty that leads to volatile Monday opens. And this is where most people misunderstand what's happening. Markets are not reacting to outcomes right now. They're reacting to possibilities. Oil didn't drop because a deal happened. It dropped because traders thought a deal might happen. Silver didn't bounce because conditions improved. It bounced because the market temporarily believed they could improve. But as of right now, nothing is resolved. The Strait of Hormuz, one of the most critical oil choke points in the world, is still effectively constrained. Around 20% of global oil supply normally moves through that narrow passage. When that flow is disrupted, energy markets don't just tighten, they shock, and that shock spreads. Higher oil prices don't just stay in the energy sector, they move through the entire economy. Shipping costs rise, manufacturing costs rise, food production becomes more expensive, inflation starts creeping higher across the board, and once inflation moves up, the Federal Reserve has a problem. This is the chain that matters more than anything else right now. Oil goes up, inflation follows. Inflation stays elevated, the Fed holds rates higher. Higher rates strengthen the dollar. A stronger dollar and higher yields pull money away from assets like silver. That's why silver hasn't exploded higher, despite geopolitical tension. The pressure from interest rates is stronger than the pull from safe haven demand. That's the part most people get wrong. They assume conflict automatically sends silver higher. But in this environment, conflict is pushing oil up, and oil is pushing interest rates higher, and that's holding silver back. So paradoxically, the bullish case for silver right now depends on oil coming down, not going up. And that's why Monday's open matters so much, because oil will likely move first. If oil gaps lower when Asian markets open, it means traders are giving more weight to the possibility of de-escalation. If oil gaps higher, it means the market is rejecting that idea and pricing in continued disruption. And whichever direction oil chooses, silver will react almost immediately. Now look at where silver is sitting going into that moment. Earlier this week, it dropped hard, from around $76 down to nearly $71 in just a few sessions. That's a meaningful move, but it didn't break. That $71, $72 area has now been tested multiple times, and each time buyers stepped in. That creates a very specific setup. When a market tests a level repeatedly and holds, it builds a base. Not a guarantee, but a signal that there is demand underneath. And when price is sitting above that base going into a high uncertainty event, the reaction can be fast once direction becomes clear. But here's the reality. Both directions are still on the table. If the U.S. signals rejection of the proposal, oil could spike back toward recent highs. That would likely strengthen the dollar again and put pressure back on silver. On the other hand, if there's any sign of progress, even partial, oil could pull back further, easing inflation pressure and giving silver room to move higher. This is what makes this moment difficult. Not because there's no information, but because the information points in opposite directions at the same time. That's where most traders get caught, trying to force a clear answer when the situation isn't resolved yet. And this is where recession warnings becomes critical. Not predicting direction blindly, but understanding the forces underneath the price. Because right now, silver is not moving randomly. It is reacting to a very specific set of inputs: oil, interest rates, and the dollar. And all three of those are being driven by one central question: whether this geopolitical tension begins to ease or escalate. As we move into Monday, the market isn't looking for perfection. It's looking for a signal, something credible enough to shift expectations. And once that signal appears, the reaction won't be slow. It will be immediate. As Monday begins to unfold, the most important thing to understand is that the market will not wait for confirmation. It will move on interpretation. That's where people get caught off guard. They wait for a clear headline, a final decision, a confirmed deal, and by the time that arrives, the move is already underway. What matters in the first hours of trading is not certainty. It's direction of belief. So the question becomes very simple, even if the situation itself is not. What is the market starting to believe about this proposal? If traders begin to believe that this is a real step toward reopening the Strait of Hormuz, oil will move lower quickly. Not gradually, quickly. Because a large part of the current oil price is built on risk, the risk of disruption, the risk of escalation, the risk of supply being constrained. The moment that risk starts to fade, even slightly, the premium comes out of the price. And when that happens, the entire chain begins to reverse. Lower oil reduces inflation pressure. Reduced inflation pressure gives the Federal Reserve flexibility. Even the possibility of future rate cuts starts to come back into the conversation. The dollar weakens, and silver, which has been held down by that strong dollar and high rate environment, finally gets room to move. That's the bullish path. And it does not require a perfect outcome. It doesn't need a signed agreement or a full resolution. It only needs a shift in expectation that the situation is improving. But there is an equally important path in the other direction. If the market interprets the U.S. response as rejection, not hesitation, but rejection, then the entire risk structure snaps back into place. Oil doesn't just hold its level, it moves higher again. Traders reprice the risk of prolonged disruption. The idea of reopening the strait gets pushed further out, and that pushes energy prices back toward the highs. From there, the same chain works in reverse again. Higher oil reinforces inflation. Inflation keeps the Fed locked in, the dollar strengthens, and silver comes under pressure once more. Not because silver itself changed, but because the environment around it tightened again. This is why watching silver alone on Monday morning is not enough. By the time silver moves, the signal has already happened somewhere else. The real signal is oil. The second signal is the dollar. Silver is the reaction. So instead of asking, what is silver doing? The better question is, what is driving silver right now? And on Monday, the answer is very clear. It's oil's reaction to geopolitical expectation. There's another layer to this that matters just as much, and it's positioning. Silver is not coming into this moment from a position of strength or weakness. It's coming in balanced but sensitive. The repeated tests of that $71, $72 level created a floor, but not a confirmed reversal. The bounce back to $75 shows responsiveness, but not full conviction. That creates a setup where the first strong signal gets amplified. Not because the market is certain, but because it is waiting. And when a market is waiting, the first clear push tends to carry further than expected. This is where people make mistakes. They see the first move and assume it's over. They see silver jump and think they missed it. Or they see it drop and assume the downside is finished. But in reality, Monday's move is more likely the beginning of a directional decision, not the end of one. And that's why patience becomes more valuable than prediction here. Because forcing a bias before the market reveals its direction is exactly how traders get trapped. Especially in environments like this, where both narratives sound reasonable and both outcomes are possible. There's also a psychological layer that plays into this. After a volatile week, people want clarity. They want a clean story, a simple explanation they can act on. But this is one of those moments where simplicity doesn't exist yet, and trying to force it leads to bad decisions. The market is in a transitional phase. It's moving from one set of expectations to another, but it hasn't decided which direction that transition will take. And that means Monday is less about certainty and more about observation. What you're watching for is not just price movement, but how that movement behaves. If oil drops and holds lower levels, that's different from a quick drop that immediately reverses. If silver moves higher and builds on that move, that's different from a spike that fades within hours. These are the signals that tell you whether the market is committing or just reacting. And commitment is what matters. Because once the market commits to a direction, once it starts to believe in a particular outcome, that's when moves extend. That's when trends form. That's when the environment becomes clearer. Until then, everything is just positioning and reaction. So going into Monday, the focus should not be on guessing the outcome. It should be on identifying the shift, watching how oil opens, watching how the dollar responds, watching whether silver confirms or hesitates. Because the truth is, the opportunity doesn't come from being first. It comes from being aligned with the move once it becomes real. And right now, as we sit here before the open, that move hasn't been chosen yet. What has been created is tension. Tension between expectation and reality, between hope and skepticism, between a proposal that exists and an outcome that doesn't. That tension is what the market will resolve next. And when it does, the reaction won't be quiet. It will be fast, directional, and driven by whichever narrative wins in those first critical hours. That's the moment to pay attention to, because that's where uncertainty ends and direction begins. And in a market like this, that shift can define the entire week ahead.